you. Hi, welcome everyone. I'm trying to see if people are starting to join us now. From our previous broadcast a week ago, we know that we have more than hundreds of people joining, so it takes a little bit of time. But I'm very excited to have our second session here today. We're talking seed strategy today and answering some of the pressing questions founders have around this topic. And before we're going to launch into that, and I'll introduce our guest and ask some of the questions, I would like to introduce Martha Moses, who's a marketing manager at Google for Startups. And we're very excited to partner with Google for Startups. Is a global organization that is doing so much for startups around the world. Their programs are really amazing. We've been fortunate to have long-time relationship with Campus Tel Aviv. But seeing who attends our podcasts from around the world, the global reach of Google is for startups is really amazing. Hi, Martha. Can you hear me?
Hi, Shuli. Can you hear me okay?
Hi. Yes.
Hi. Great. Good morning. Good morning, everyone. As Shuli mentioned, my name is Martha. I'm the, okay. A little bit of a delay. So I am the marketing manager at Google for Startups in Tel Aviv. And for anybody joining the call who doesn't know about Campus, we're a physical space to help early stage startups grow with the best of Google. And when COVID-19 broke out, we moved all of our activity online, including mentoring and Google connections and helping startups with our products and online events like this one. And so you're invited to learn more about our events that we offer on our website. And we're really excited to partner with UpWest, who have been great partners with us for a long time now. And when we all got together, we thought of the content that we'd like to create. We put an emphasis on the pain points that we heard directly from the founders that we work with day to day. And the number one thing that they all said is that it's super helpful for them to hear from VCs and raising funds. And especially since many of our startups are in the seed stage round, events like this are perfect for them. So thank you so much again to UpWest for being amazing partners, and stay tuned, and we will have, throughout the month, we'll have more events like these. So if you want to hear more and register to events like these, just Google us, Google for Startups Campus, and stay in touch. So I'll pass it back to you, Shuli.
Thank you so much, Martha. Really appreciate a lot of the stuff that you do for companies, and then for being part of this. So as I mentioned before, here at UpWest, we're in Silicon Valley and do a lot of our activities cross-border, investing in Israeli founders who are targeting the US market at pre-seed and seed. We've been fortunate to back a lot of great founders since 2012. And this is a really great opportunity for us to talk about what's really going on in the seed landscape. And we have a perfect guest for this today. Joining us is Jeff Clavier, who's the founder and managing partner of Uncork Capital. And he's one of the earliest seed investors in Silicon Valley. Started as an angel investor, but since 2004, had been investing in a lot of emerging Web 2.0 companies. At the time, there were only a handful of individuals who were doing kind of a pre-seed and seed investments. And they really pioneered the micro VC movement in Silicon Valley in those early days, and to what we know, is today, and provided tons of leadership of how founders should think about raising seed, the different sources of seed, and kind of fueling that industry very early on. Since then, Uncork raised multiple funds. The latest one is a $100 million seed fund, along with a $100 million opportunity fund, and has been investing in really incredible companies across multiple sectors. Jeff has really notable investments such as Fitbit, Sendgrid, Eventbrite, Front, and many others that I will let him, mention some of them later. But I think for me specifically, I'm really fortunate to have Jeff as part of a network for many years. We've known each other, I think, since probably 2004, 2005, when you were active in, angel investor, and I'm very fortunate to have him around as a mentor, kind of cheerleader, as I've been building UpWest myself. So a lot of lesson learned from him. So thank you for joining us. My first question to you, Jeff, is about the environment that we are in today with COVID-19, and seeing that, particularly I wanted you to talk because of your previous experience through downturns as an investor, and seeing various cycles as seed investor. And I wanted to kind of have your lens and in portraying to founders, what happened in previous downturns and what's different about this one. When this hit, what really went through your mind as an investor, and what can you tell us about what you've experienced in the past versus what you think will happen to us this time?
Wow. Can I have an hour to answer the question? So Shri, Gil, thank you so much for having me. It's a pleasure to be with you and with you all. I can't see any of you, but it's a pleasure to be with you. Yeah, it's my third downturn. I moved to the Valley back in 2000 and became a VC at the worst possible time when the 2000 bubble was exploding, and I dealt with that, and then started the firm in 2004, as you said, and then just after I raised Fund 2, which was our first kind of institutional fund. It was a small $15 million fund that I raised in 2007. It was one of the first micro VC funds in history, and boom, 2008 hit, and we had to sort of deal with that. So this is my third. I think what's very different with this one is that it's actually not, a financial crisis at the beginning, right? 2000 was a public market bubble. 2008 was a credit bubble. This is a healthcare bubble. And so we're dealing with sort of the consequences of a healthcare, sort of massive challenge where, we try and sort of figure out what that means for companies or startups and, the health of our ecosystem. I think that, so we've been sheltering in place for over 8 weeks now. We started a week before Governor Newsom sort of said, hey, stay home and don't go to the office or anywhere. And immediately we jumped into triage mode. So triage is this sort of keyword in VC land that says, oh, the world is in shambles. Let's just figure out how exposed our portfolio is. And so you're going to look at a few things. One is, what is your exposure to COVID? Like, because COVID has shut down entire parts of the economy, which companies are, in hospitality, restaurant, travel, education, and so on and so forth. And let's figure out what the action plan is for those companies as quickly as possible. And unfortunately, for those, that typically sort of meant, getting 50, 75, over 80% of the resources sort of laid off so the company can conserve cash, because there's basically no market. We had companies move from millions of dollars in revenue to nothing from one day to the next, because restaurants were all shut down in the US. Then there was the cash runway question. So we tried to figure out which companies were in the bucket of, we have less than 6 months of cash. What do we do? Let's try and raise or massively cut burn. We have 6 to 12 months, so we're okay, but let's extend runway. And if we're 12, 24, let's see what sort of risk we're at, because we don't know how long it's going to take to get back to a sense of normalcy. in terms of investment pace, size of rounds, valuations, and so on and so forth. And if I use my previous experience, in 2000, it took about 18 to 24 months for VCs to get back to normal in terms of investment activity. So the trough really hit in 2001, and things were sort of back to normal in 2003, 4. In 2008, it really took about 18 months. So it hit us at the end of 2008, and things were sort of back to normal early 2010. So assuming that VCs sort of behave now as they behaved then, it's probably going to take 18 to 24 months for things to get back to normal. So let's make sure as many companies as possible have 2 years of runway. And the 2 years of runway is completely arbitrary. We don't know, right? We just know that trying to raise capital now is very, very hard, because unlike other periods of time where we're open for business and we want to, spend 30, 40% of our time, in fundraising with startups. So we look at, deal flow, we, meet entrepreneurs, we try and figure out, of 50 meetings, which one company may be, sort of interesting. We are spending most of our time focusing on the portfolio, right? What we do on a daily basis is support our founders to try and sort of figure out themselves how to deal with all the issues that COVID has created. And the thing is, a lot of our founders tend to be sort of young founders. They may not have been around in 2008, 9, 10, and so they don't really know what a downturn or a crisis would look like. And certainly, a lot of them were not around, in 2000. And so we just have to try and pass, upon them this, experience I've had, back in the day, as to what it means to run a startup in this troubled environment.
Yeah.
So,
and I think, when I look back at 2000 and at 2008, the seed landscape in terms of capital was not really mature yet. I mean, there were few people, most of the funding was, the traditional institutional VCs, and we kind of measured that mostly, I guess, in terms of activity back to normal. My question to you, Jeff, and we've both been active in the last I don't know how many years, and particularly in the last few years, we've seen the seed landscape of the the active investors in the seed kind of ballooning. I don't know if it was like 600 funds or 800 funds that are in the market.
Let's make it 1,000.
Let's pick 1,000.
Let's pick 1,000.
2019, seriously, there were so many new active seed funds. So from a founder perspective, there should be a lot of money out there in the seed category. And so what can we, what do you think about that? How do you anticipate that all that capital is going to be deployed? I mean, because there are different investors in that pool. And how do you think they will behave in terms of, are they going to retract, do less investments, going to deploy their fresh funds? What should founders think about the kind of the pool of capital that is out there designated for seed right now?
I think you're absolutely right. And I do think that there are over 1,000 micro VC funds now, between the pre-seed VC, the seed VC, the post-seed VC, the pre-A's. There's a wide swath of funds out there that have been raised over the last few years. So, the original sort of group of super angels back in the day was a dozen people. And in 2007, 2008, there were, a dozen funds, right? Yeah. And now the landscape has grown by a 100x factor, which is crazy when you think about it. And I think that's actually a silver lining for founders today, is that there's a lot of funds which have been raised over the last couple of years from founders who've never been sort of VCs and never been sort of exposed to a downturn. So they don't have sort of this muscle memory and the pain that, got us to move into triage mode instantly to figure out what was the landscape of our portfolio. And so far, I wouldn't say so good, but so far not too bad, because we happen to have raised a lot of capital in the portfolio. So it's not like we're closed for business. The key thing that you want to ask to a VC is, when is the last time you invested in a fresh, brand new company, right? Not a follow-on investment, not a bridge, not a an extension. It's a brand new investment that you wired into a company. And to us, it was yesterday, right? And so as long as the person you talk to has invested and deployed capital in the last couple of months, it means that they're pretty active. Yeah. And that's sort of the intel. Like, as a founder, you always want to be super prepared when you go out and fundraise, right? You want to be ready with your pitch deck. You want to be ready with your due diligence material to prove your market, have your list of personal references. You need to sort of have everything sort of buttoned down, so you can have an efficient sort of fundraising process. And you want to know exactly who are the firms and VCs that you want to target, because it's not because someone has raised a VC fund that they're a target for. Some people will have clear sector considerations. We're broad-based. We do SaaS, SaaS B2B enterprise. That's sort of the core these days. But we still do a bit of consumer. We do a bit of marketplaces, do a bit of hardware, do a bit of frontier tech. So there aren't sort of too many categories that we don't invest in, right? But some people are very focused.
And from experience, I think that, a lot of founders don't spend enough time collecting intelligence and researching the various funds. Not only, who can make me an introduction into this fund, or how do I get to that particular partner, but really understanding the size of their funds, the size of checks they write, do they follow? Are they leading rounds? And as you said, and I think that a lot of founders are a little bit holding back in asking the right questions, and you can ask that question of, when was the last investment you've made? Because that's how you qualify whether or not that fund is, active or not. Active.
Yeah. And so, knowing the stage, some people who are ideation stage. So, a couple of founders, great idea, a bit of background material on the market opportunity, and that's it, no code. That's pre-seed. So what you want is to go and reach out to pre-seed funds, because for me, for example, that will most likely be too early. I don't invest at ideation stage, I invest at code stage, which is typically 6 to 9 months after the ideation stage. As you said, size of checks. Some people reach out to us saying, hey, I'm raising $500,000 at like Uncork to participate, and that's awesome. We're grateful for the interest, but my minimum check size is kind of in the $1 million range, and my sweet spot is $2 to $3 million, sort of seed rounds. So trying to understand really what are the different parameters that funds have in order to invest is really important. For example, some US funds will not invest in Israel. We happen to have done an awesome investment in Israel a couple of years ago, Turi, which, we're very comfortable with the notion of investing in a US go-to-market and product engineering being pretty much anywhere in the world. So the Israeli model is for us. So understanding all this is really important, because that's going to, narrow your funnel, and that will make your introductions way more, efficient and effective, because you can't, ask for introductions to 150 VCs, but you can pretty much get introductions to 25 or 30, right? And in this environment, the notion of, okay, so are you actually active? Are you actually investing for real? And, everybody says, oh, we're open for business, we're investing, but it doesn't mean shit, right? Because as a VC, I will never put a sign saying I'm closed, because by definition, that would kill my deal flow. So everybody's going to pretend that they're, open for business and meeting founders and doing deals, which is very true. Since the beginning of the pandemic, we've done, we've closed 3 investments, right? So we're definitely open for business. But what is very true is that the really percentage of time that we spend on external deal flow has shrunk from 35-40% to, depending on the week, the ebb and flow of board meetings and the emergencies or whatever, to as little as 10%, right?
Yeah.
So that means that we're spending way less time with founders trying to get them on the platform because we're just busy. And I can tell you, we're really busy right now. Just because we deal with, the cycle of updates and meetings we have with our founders, and then we deal with the unplanned calls, texts, hey, let's jump. I need, there is this program called PPP, which is the payroll protection program in the US. And a lot of our startups have, tried to figure out whether they should apply and how to apply and what that means and whether there is any risk or whatever. And we spent a ton of time, talking to lawyers and consultants and a bunch of people who can advise us so we can actually in turn advise our companies. And that's top priority. And so when I was saying that there was maybe a silver lining for founders with all these funds we have raised, they've raised something in the past couple of years, is that they are not as heavy on portfolio management as we are, because we have, give or take, so we've done 226 investments, I think, in the last 16 years, and we probably have like 100 active portfolio companies, give or take. And while I haven't talked to 100 of those CEOs in the last, 3 months, we've certainly reached out and talked to a lot of them. And that's why the workload is so heavy. When you have, a dozen portfolio companies, that's much faster. And so where we will be, and people who have been around for a while, will be really heavily loaded on portfolio management, a lot of the more recent funds may actually not. So
what you're saying is that basically the window is, kind of shrunk a little bit in terms of, attentions of VCs to new deal flow, because they've been obviously working with their existing companies to make sure that they have enough capital to sustain the crisis. What I hear a lot from founders, and definitely it's on the mind of a lot of founders who, are kind of like in the ideation stage, or have a little bit of maybe proof of concept or something like that. And they were planning on going out and fundraising, to have an 18 months of runway and strategizing for that. So a lot of the things on the mind of founders right now is timing. What are the questions that founders need to ask themselves right now when they need to decide whether or not to fundraise right now, or maybe wait a few months? What do you feel is really smart for them to do, given the attention that investors, don't have, given the current crisis? I mean, what do you suggest in terms of timing?
Yeah, that's a really tricky one, because for our own founders who are kind of thinking of fundraising for, a Series A or Series B or whatever, we look at their runway and we say, well, if you can wait, you should, because, it's because the landscape we have for our own companies raising downstream capital, Series A, Series B, Series C, is the same. Like, everyone is focused on portfolio triage in more established, larger VC firms. And so if we can avoid fundraising, then we will. And if we can't, then we'll basically say, hey, it's going to be all hands on deck. We're going to try and pre-qualify as much as possible. So do this work that I mentioned, which is, okay, so who is a typical target for you based on your sector's geography, size of the raise, and so on and so forth. And who's really active right now and could write a check. And because we know everyone in the market, we can have a very open conversation saying, are you guys really looking into companies, or are you just going to take a meeting to get some data point and say, hey, let's just meet again in 3 or 6 or 9 months? The problem is that no one knows what that window really looks like. like during the financial crisis, people were like, well, I need to make sure that I have capital to invest because I'm not even sure my limited partners are gonna respond to my capital call and give me cash because the whole financial world was in shambles. It's not the case this time. The big question is, well, when will people feel sort of both safe enough to sort of have face-to-face meetings? Because the one thing that everyone is struggling with on the VC side right now is making commitments to founders that they have never met, right? Because when we meet, when we spend time face-to-face, we pick up on those little details that make us sort of comfortable to invest in a founding team or not invest in founding. One thing that we try and understand is founder dynamic, right? And the way we do that is we put them, in a room and we sort of ask a bunch of questions and see how, they sort of behave. It's very hard to get those cues on Zoom because even though you could have, 3 windows with 3 founders, it's just not the same interaction. And so we've just made 2 commitments to founders we had never met and we've never met, face to face. And, so we went over that hurdle, but we tried to figure out how to get, references done in a way that makes us sort of comfortable with that.
So let me ask you a question about that one, because I think a lot of founders are thinking, what if this will never change and this is going to be the new normal, where we're going to have to pitch on Zoom, or we're going to have to, get to know you on Zoom, get comfortable on Zoom. So the question for me is, and we all know that when we look into new companies, there's a lot of signaling that comes from various places in order for us to get comfortable. Do you feel that those signals now that you pick up on a particular founder, a particular sector, on a particular team, it coming from a particular, as you say, references, you put more weight on that now that you can't meet the founders face?
Yeah, because basically what we're doing, we always do that. So we rely on sort of proxy signals. So let's say that you should introduce me to a team and, you say, hey, this is why I'm excited. This is why I think it's a perfect sort of investment for you. This is why I think it's worth, your meeting. That puts the signal, a very strong signal, from a sourcing standpoint. And I will sort of use the same mechanisms looking at who do I know, who knows that founder, who can tell me what's been their experience working with them, hearing about them, being pitched by them. Because essentially, if I don't have, the possibility to meet someone face-to-face, I'm going to try and find someone who has met that founder face-to-face and try and, rely on my trust in them, in their judgment, as a proxy for, how I sort of see that founder. And so we're going to rely on the network even more than we typically do.
So if I look at it from a founder perspective, that warm introduction that, creating is super important, even more important now than it was before.
Yep. But at the same time, a lot of founders say, hey, I don't have any network our networks sort of don't overlap. And so I can't find anyone who can sort of introduce me. LinkedIn is your best friend. Crunchbase gives you a bunch of information. So, I always have a hard time when people say, well, I don't know anyone who knows you, because I know a lot of people. But okay, granted, you can also sort of try and give a shot to a cold, sort of outreach over email. Yeah. Don't text me. Don't call me. LinkedIn, email. I barely pay attention. When I have time, I do. When I don't have time, I don't. So a really, really well phrased email, a catchy sort of headline, a 1 paragraph, a link to a DocSend link to your deck or to a teaser deck, and the probability of me reaching out. I read every single email. and I always reply saying no, to cold outreach. But in the life of Uncork, of the 226 investments we've done to date, 2 were actually cold emails. And one of our most recent, most promising companies, Coder, came through a cold, outreach. So we know that we have to pay attention. Obviously, the bar is much, much higher. And I think, we're talking about timing and how long it takes. I think that the problem is, if you're doing something which is truly unique, where there's no competition because of your unique IP or tech on the market and so on and so forth, I think, this timing is as good as any to raise. If ever you're playing in an existing market as, hey, I'm better than, those companies in cybersecurity or in, sales enablement or whatever, then there is already so much noise in those markets that we have a hard time getting excited for those sort of either add-ons or things which are kind of better, but not so novel that it's clear how they will differentiate. And so we tend to put a premium on things which are truly sort of unique. And, if I look at the last 3 investments of the 3 commitments we've made since the beginning of the pandemic, they're really sort of unique.
Yeah.
The way they sort of tackle, their respective markets. It doesn't mean that, founders should not try and raise if they need to. I think that's one of the fundamental questions. Do you need to raise, or can you sort of continue bootstrapping, or can you do an angel, sort of angel round, friends and family, something which is not institutional? Do you have sort of means to, survive for a few months without, sort of fundraising? And if the answer is no, then just go at it and do a really good job trying to figure out your funnel of investors and use your contacts to figure out who can make introductions, but also can qualify that someone is actually active in the market. Because when you're in public, you're always open for business, but in private, you're telling people, look, I'm barely sort of taking me.
Before we go into like the various type of investments that you feel are kind of categories that will be up and coming, and versus the ones that we're gonna take off the shelf maybe because of this situation, you touched a little bit about other sources of funding, and I think that is really important for founders to understand how to bootstrap and maybe exercise that muscle as well, because not all the money comes from VCs and from funds. I mean, there are opportunities to get funding from other sources, and you were an angel investor before this. The question for me is, in times of recession, what happens to angel investors from your experience? And are we going to see them more active, less active? Is this something that typically kind of gets them to step back?
Yeah, I think it sort of depends, because the fundamental rule is you should always invest and look at investing at some kind of a consistent pace during good times and bad times, because you have so many kind of amazing companies that were created during the 2008 recession, and so as an angel, you should really sort of try and invest at sort of this regular pace. Unfortunately, a lot of angel investors, because their personal sort of wealth being dispersed, they look at whether they feel sort of rich or less rich or kind of poor, even though poor may be sort of extreme. And when you have sort of a plunge of the public markets like we had, about 35%, you suddenly feel much poorer, because you look at your public market exposure and you're like, shit, I don't have as much cash as I used to, so I'm not going to start investing in super risky assets. At the same time, the pool of angels, is very broad when things are good and much narrower when things aren't. But you want to work with angels who have actually been through those kinds of tough times and still deploy capital anyway. So I think it actually helps your selection to try and raise during sort of challenging times. And, you know, as I was still deploying capital in 2009, 2010, and made actually really great investments. That's when I invested in Sendgrid. I mean, Fitbit was just before the crisis. Eventbrite and Sendgrid were both during the crisis.
Yeah.
So
that's and we've seen companies now taking advantage of different grants and
yep.
you know, government loans and bank loans and things like that. So you know, and obviously since the last recession, there are many pre-seed investors in the form of accelerators and innovation programs and places where you know, potentially can get funded a little bit in order to help you bootstrap. And founders are looking into a lot of different kind of categories if they feel like they're not ready for going out and fundraise. But do you feel—
you have this thing called revenues?
Yes, right.
So, you know, it's trying to get, it's not the fastest way of getting funded, but, you know, you have companies which started on the basis of a proof of concept, paid proof of concept with their first customer that gave them, you know, 25 or 50K or whatever, and accepted the risk of working with a startup. And they got bootstrapped thanks to that contract, right? So it's always, it's never easy to get funding, and you have to be sort of innovative in the way you try and raise it as well. And that's how, you know, Atlassian sort of never actually raised capital to build the product. They started raising money to do their first secondaries, right? So they bootstrapped their way to whatever, millions or tens of millions of dollars in revenues. And I remember those dudes because they were hanging out on University Avenue across the Acxiom you know, office, where you and I sometimes were grabbing coffee. And one day I just said, "What are you guys doing?" I said, "Oh, you know, we have this small startup made, you know, it's called Atlassian." "Oh, it's cute." The next thing I know, they raised like $60 million from Acxiom.
Yeah.
Right?
That's right. So yeah, so definitely bootstrapping and trying to reach revenues super early. I think it's, you know, it's really important. We've seen in 2019 seed rounds being as big as, you know, I think average I read was like $5.6 million seed round. And do you see that will shrink? Do you think the size of seed will shrink? And do you think that founders will be able to raise on a PowerPoint like we've seen in the last couple of years? Or do you think that investors like you will be demanding, you know, more KPIs and more proof and more things that will give you kind of comfort to deploy seed round?
Yeah, I think, I mean, so what are the components, right? Founders, experience, expertise, you know, track record, product, and market opportunity, right? So if you attack a really massive market opportunity and you have some kind of a track record, so that may mean, you know, you're not like a first-time team, you're like a, you know, veteran type. Then I think you have like that's the definition of the team I just backed, which has just a basic prototype of the product that they're going to go and build. It's a very experienced team, you know, I would say sort of real experts in their target market, and they're going to go and fundamentally sort of change the game in terms of price point, because their solution is 50 times cheaper than what you buy today. And so I made the bet that the team is experienced enough and the market is massive enough for me to take the risk of investing super early in something which is really kind of ideation plus, right? And to be fair, the price of the deal reflected the risk I took in terms of the very early stage nature of the company. And to your point, they tried to raise $5 million. COVID happened, everybody passed. And so as opposed to raising a $5 million seed round, they raised a $1.6 million pre-seed round. And I jumped in with another awesome, pre-seed investor, my friend Sunil at Ubiquity, and we're hardest, to get the company to the next level. And we'll see whether the next milestone is the seed round or Series A. So to your point, because of the overall sort of super risky environment and a lot of unknowns, I think that, the size of rounds is probably going to shrink a little bit, and valuations are probably going to shrink more than a little bit.
Yeah.
I would say, just out of a few data points, we've seen kind of 20-ish%, 25% sort of drop in valuations, but valuations were absolutely batshit crazy insane over the past year and a half. So we're probably back to, 2017, 2018 kind of normal valuations right now. And we'll see how things sort of go. The other silver lining for founders is that, I remember what it meant to invest at seed stage or pre-seed stage below 2 pre. Right? I invested in Sendgrid below 2 pre.
Yeah.
Right? Fitbit was a $2 million seed round. $2 million, insane, back in 2008. That was like
that was huge.
That was huge at 5 pre, right? Those valuations I haven't seen for a long time. And so you have a lot of kind of new VCs out there who don't have this sense of what real sort of pre-seed valuations mean, right? It's like single digit, like 2, 3, 4. And therefore, if you put something compelling in front of them, given that there is always this sense that because there's 1,000 funds in the market, there's always like 10 funds looking at an opportunity, and they can't try and price, the company right. They're trying to price the company at sort of aggressive enough valuation so they can win the deal.
Yeah.
So, we'll see. I think, net rounds are going to be a bit smaller, valuations are going to be a bit lower, and pace is going to be slower. But it doesn't mean that things are going to just shut down. Because if you have raised, some capital, kind of expected to deploy, right?
Yeah.
You don't really sort of sit on your fund and make management fees, and not, work hard to try and bring, sort of opportunities to your LPs. So the big question for me is like, from a window perspective, so, Q2 is gone, right? In terms of active sort of fundraising. So we said, hey, let's try and delay any sort of active fundraising until Q3 and Q4. But where will we be? Will the economy start reopening? I think there's going to be tremendous pressure to try and reopen by June. I mean, you and I had the discussion a couple of days ago in a work call. The question is, can we do that safely, or are we just going to, restart the crazy curve of all zero, sort of going back to 1.1, 1.2, 1. Whatever, which would mean sort of another lockdown, right? Which would be sort of really, really detrimental. And I have a board meeting with my LPs this afternoon, and my own sort of analysis is, look, we have exposure to COVID. It's bad, but it's not that bad. But it could become really, really sort of much worse in Q3. And I'm not really worried about our Q1 valuations. I really am worried about our Q3 valuations. And so depending on how people feel, they're going to, as you said, they're going to hold back on investing in new companies because they want to have a bunch of reserves for their own companies. Because, you can tell someone, hey, delay your fundraising a few weeks or a couple of months or whatever. But at some point, they're going to need to raise money, right? And it's either raising money from you and insiders coming together and doing an inside round to, extend the runway of the company by, 6, 9, 12 months, or it's like, well, there's no real sort of insider support for any reason, and we just have to go out. And in that case, we typically tell our founders, plan 6 months, to raise your next round of financing, and in this market, it's probably 8 to 9.
Yeah. Yeah, so it's longer cycle. There were lots of questions from the audience. Particularly, I think, people wanted to know about particular domains. And so, Jeff, you and Uncork been, building a pretty diverse portfolio, and have been, looking at a lot of different sectors over the years. I think, you've invested in some hardware companies like Molecule and Fitbit and August Lock. And what is your sense about the hardware market? Or, do you think this is, for founders building companies with hardware components, do you think this is a good time? Do you think this is going to be more difficult, more challenging? How do you view that in terms of fundraising?
Look, consumer hardware is very, 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 very hard.
Yeah.
As one of the most active sort of investors in consumer hardware, I've actually sort of toned down my investment pace. I haven't done anything new in consumer hardware for 2 years, 2+ years, just because it's so hard to find downstream investors who are willing to take the risk of supporting a consumer hardware company. Because typically, like, what has enabled a lot of the micro VC movement is capital efficiency. The fact that you can build companies on the cheap and really sort of get to a bunch of proof points and market traction before you need to consume and burn a bunch of capital, and the cost of failure, has dropped dramatically. Unfortunately, cost of failure in hardware startups is still massive, right?
Yeah.
You don't sort of get anything, done for less than $5 to $10 million in seed plus, sort of venture debt and stuff like that. And, to start to getting to, market with a product is typically sort of a $15 million kind of price tag. And I've just found that the enthusiasm that was, around in market after, Fitbit success and a few others has basically evaporated. And so consumer hardware is really, really tough. There's still, it's still feasible. There are people who get funded. There are funds that are focused on hardware companies. It's just going to take a while, and understand that, the road to Series A and Series B is very tough. Right?
Yeah.
Industrial hardware, I think it's actually sort of a bit easier. And that's where I spend time.
Yeah.
So I've done a few sort of industrial hardware investments, and because it's industrial, it's not like it's different buying cycles, most of enterprise sales, especially if you have in those, the assumption is that you need a recurring revenue kind of model. So a lot of the companies we've invested in are what I call hardware enabled SaaS. So customers would pay for a software component that is predicated on having a piece of hardware installed, in a factory or something like that. It's
what
hard.
About other areas? What about other areas that you're excited about? How do you look at? I know you guys have done a bunch of retail and bunch of companies and marketplaces, fintech, different SaaS or healthcare.
Yeah. So SaaS. What we try to do is have some kind of a COVID kind of filter. Retail has been decimated, right?
Yeah.
Get a big retail bankruptcy announced every couple of days in the US. So obviously anything retail we're going to try and stay away from. Anything hospitality, anything travel, like anything which is hard hit by COVID, because we don't know how long it's going to take for the sector to come back, and then investments to be made, right? When are you going to if you're a retail startup, when is someone going to pick up the phone to consider buying your solution when they're looking at closing 20% of their stores, right? Not going to be a good one. So we have this sort of COVID sort of filter, and we'll look at I would say probably sort of, so definitely investing in must-haves. So, you know, security, compliance, kind of reinventing industries. So that's what the startup I've recently backed is basically sort of reinventing one part of the enterprise infrastructure at a cost differential, which is insanely attractive. And so the bet is that people will sort of buy their product, even if, you know, there aren't that many investments made, because they can save massive amounts on total cost of ownership. So it's really sort of figuring out what is kind of COVID proof of sort, and focusing on those, you know, for the foreseeable future.
A few years ago, you know, we saw like a wave of companies building for VR. Do you feel that AR and VR will make a comeback because of this? Do you feel that there is more, you know, interest in that right now?
You know, it's a really, I mean, it's a really interesting question, because VR was doing really badly over the past, you know, couple of years. We've had a ton of, you know, so-called hyped sort of VR companies go, you know, down the drain, and expect that a lot more will actually sort of die. And it's very challenging. I have an awesome sort of VR company that has made a lot of progress, but it's been tough to fundraise, you know, for them. So they got it done, but it was very, very challenging. So I would have said before COVID, it's a very, very tough market, because, you know, VR isn't mainstream yet. Everybody kind of expected or hoped that VR and AR would be more mainstream than it is, you know, by now. But given that we don't have this, you know, face-to-face experience anymore, we can't go to the movies, we can't go outside, we can't do things or whatever, then VR becomes an interesting, you know, kind of alternative to spend time and get some kind of entertainment. So we'll see whether VR gets a boost out of COVID. I think it's jury's still out, because the products are kind of okay, but not great. And so we'll see.
Yeah.
Open question.
Do we have any more questions? You know, I think we've answered pretty much, you know, a lot of it. Just wanted to see if you have any final thoughts or advice you want to share before we're closing, with people building right now, thinking about markets, thinking about, you know, the next, you know, 18 months, what do they need to do and focus their efforts. Primarily, I think, you know, how should global founders who are not, you know, in their market in the US should think about it, and how is this, you know, impacting them?
Well, I think that it's actually good news, because the one big winner in this whole sort of environment is this notion that you can really sort of build companies on a fully distributed, you know, sort of basis. And we were certainly, like, if you had interviewed me 2 years ago, and you remember.
Well, I remember that conversation, Jeff.
Right.
10 years ago, when you said to me, "Oh, we don't believe in distributed team."
Yes.
When I was, you know, talking to you about one of the companies, and you said, "Everybody have to be in the same place."
Everybody on one roof. Everybody on one roof. And that was the way, you know, a very successful sort of generations of companies have been built. But then, you know, tools sort of evolved in a way that actually sort of enables remote, distributed, telework, and so on and so forth. And for the past couple of years, we've been preaching that move to our own companies, saying it doesn't make any sense to try and build, you know, your engineering kind of team in San Francisco, where you're competing with Facebook and Uber and Google and those, you know, and essentially the reason why those seed round sizes have bubbled is because the cost of building has bubbled in the call centers, whether it's, you know, Silicon Valley, New York, bust and so on and so forth. And so a couple of years ago, we said, okay, screw that. Let's just flip the model and say the tools and the processes have now evolved so we can actually have go-to-market in the US and product and engineering pretty much anywhere. And when a company raises a Series A, in the portfolio, we have a very active conversation about, hey, like, let's be intentional about where we build engineering, and let's decide whether it's all under one roof, old school, with a engineering sort of team, sort of development center in San Francisco, and openness to having remote work. Do we open another engineering or product development center somewhere else where it's cheaper to hire, but also much easier to retain? Because to me, it's, yes, you want to try and spend less to hire those engineers, but you also don't want to have them leave a day after their cliff, is gone, because they want to just get, a bunch of options from different companies so they can play their own sort of portfolio sort of management, right? And so we need to get better retention of those sort of that talent.
I have a couple of questions here from audience that I just want to pick. One of them is, how do you get customers and test product market fit for consumer products in a lockdown or virtually? Is spending on marketing dollars for ads that way is best?
Yeah, I think if you have consumer products and you need to sort of get in front of consumers, then do some tests, typically sort of Facebook or Instagram is what people sort of use, and run, some small campaigns at a few $100s or, $1,000 here and there to see whether you can actually get customers to try, try and go on product hunt. I mean, there's a bunch of, services and tools and approaches that any, growth hacker will sort of recommend. The good news is, if people are out of a job, then they have to spend their time, doing something. So they may actually sort of test products or do something or whatever. But, they're preoccupied. They're thinking about, the health and wellness of their families. And so it's not clear to me that launching sort of consumer products is, and I'm no longer a consumer expert because I haven't done any of those in a long time. Yeah. But I would say it's probably not top of mind these days, except if it's like entertainment related.
Awesome. I think we're out of time.
Well, it's already been an hour. Damn.
Yeah, that's been an hour. You've done good, Jeff. And this was really, I think, insightful and kind of answered, I think a lot of the questions that people had in times like this. Definitely appreciate the time you took to do this. I know how incredibly busy you are. And I want to thank Google for Startups again, and the team in Tel Aviv for co-hosting this with us. And we can't wait to next week's session where we're actually going to look into the mind and shopping list of a CIO in a big company and understand how they react to this crisis. And I think that will be super fascinating. So thanks again, Jeff. And thank you everyone for joining us.
Having me.
Stay safe and see you soon.
Bye-bye.
Bye.